Let's talk about FTX because it's kind of the big thing at the moment. It's firstly it's depressing and it makes me angry.
I agree.
But I'm also interested in moving beyond that and saying what comes next. But I'll start with you, Foss. Like,
Sure.
How did you take this whole weekend?
I'm disappointed for two reasons. I'm disappointed, and I got to call this out as a Canadian. I'm disappointed that somehow one of our big pension plans got caught up in it. Okay, so the Ontario Teachers Pension Plan, one of the top pension plans in Canada, was a Series B investor. So along with Susquehanna and Tom Brady, our Ontario teachers had a substantial loss in absolute dollars. As a percentage of their portfolio, you're going to say they're going to walk it back and say that's a couple of basis points of our. That's not the point. The due diligence was absolutely horrendous. Sometimes these deals are club deals. Oh, Susquehanna's in. I got to be in. And we'll let them do the due diligence. But so I'm disappointed there.
That's true.
I describe it. Shout out to American Hodl. I was on a Spaces chat today, and he was just laying right into them, as typically he does. So I think he's coming back on Twitter. American Hodl 8, I guess, is his handle now. I think it will get to 14 before long, but
before Christmas.
But I love the kid. But he was carving them a new arsehole, right? And it was beautiful. But the reality, he had a great statement. He goes, "The reach for yield is a fiat disease." Okay, like when you have to always pretend that there's a return that is somehow priced in, whether it's a bond or it's a yield by using option strategies or whatever, that actually is a fiat disease. So what I think is the best way I can describe FTX, I worked on trading floors my whole life, and it is a self-cleansing process because they make you go on vacation for 2 weeks where someone else prices your book. Okay, which means the trader that's sitting and it's a jungle on a trading floor. Okay, and sometimes the guy sitting next to you doesn't want you to make money because the bonus pool gets shared with the people that make the money, and the people that don't make the money, well, they get no bonus. So if you're having a really good year, but the guy next to you is having an even better year, there's a level of competition. The point is, you go on vacation for 2 weeks, someone else marks your book, which means prove that the marks are real. If you're short something, prove to me you can buy it back at that price without you adding to your position. And if you're long something, prove to me you can sell it apart from you being, the bid. And that's an efficient trading market jungle type of checks and balances. Well, the reality was Sam Bankman-Fried had no checks and balances. Mm-hmm. He was marking his book and no one was there to overlook it. Now, he's a criminal, okay? Criminal. His CEO, who, she was a math major and everything, but she's self-professed. Well, I never had to use it. She's 23-something years old. I can't believe the world placed that much trust in these two monkeys, okay? At the end of the day, it's disgraceful. However, here's the soft-hearted Foss come out. He's someone's kid. In fact, 2 Stanford law professors. Are they law professors? Anyway, they're both... they're both Stanford educated. I'm just sorry. If he was my kid, I would just be like, dude, why did you keep building and digging the hole for yourself? It started off by him thinking probably, I'll skate myself on side, but you never skate yourself on side. You dig a bit deeper hole by using this mark on FTT by defending that mark. And as long as you can defend that mark, well, the Ponzi doesn't collapse. So there were so many signals in hindsight, but I got to call out the private equity funds at the outset that they didn't do their due diligence. And whether or not this is true, the rumor is that he was playing that game, League of Legends, I think it's called, or whatever.
During the call with Sequoia.
With Sequoia. But even during the due dilly that some people, at the outset of the Series B round. So hindsight's always 20/20. I'm ashamed as a Canadian. I'm looking back on it, like the checks and balances, certainly so easy to see. And then as a dad, like, man, kid, guys, when you get on side, read, react, adjust, or whatever you say. His adjustment was continue to dig himself a deeper hole. and then the Ponzi collapsed. So,
But isn't it crazy? So like today I tweeted out something that it's kind of like FTX is kind of like the long-term capital management situation plus the tech bubble, the pain for the retail investors in the tech bubble, right? So long-term capital management back in 1998, we talk about this a lot, both of us, but it was just a leveraged play. And then I thought about it more today, and I think I saw, maybe it was Caitlin who had tweeted this, and it really resonated with me, is it doesn't remind you of Enron? I mean, where you had all these off-balance sheet entities that were just marked by them, and nobody knew exactly
Correct.
what the marks were. And so, and if you don't know what an off-balance sheet entity is, you should not be investing in crypto. And if you know what an off-balance sheet entity is, then you're a crook, and go ahead, you can invest in crypto. Because it's like, why these things these were created by Enron to hide the fact that they were their price, their market value was marked up on nothing. And so, I mean, but they fooled thousands and thousands of institutional investors on Wall Street. And so
Enron did.
Enron did.
To be clear.
It doesn't remind you?
And so
Hold on, what's that? Was it the smartest people in the room or something?
that's a book that was written on Enron.
Yeah,
correct?
I read that years ago. I feel like almost 2
And then
decades ago.
the chapter the book that's a great book for people to read on long-term capital management. It's called When Genius Failed. Both books should be
by
read.
Lowenstein.
Mine is I much prefer the When Genius Failed over the smartest people in the room. But that being said, they're both they're both must reads.
I mean, look, I sympathize with what you say as a parent, and he's someone's son. I remember when Bernie Madoff was arrested and convicted, and they sent him to 150 years in prison. I was like, that's a lot of time. I mean, for a financial crime. Mm-hmm. And then I watched the film, and I didn't realize 4 people committed suicide, including his son. Mm-hmm. And the emotional damage on so many other people.
Oh yeah, no, that's
and the amount of lives that were
awful.
destroyed. And I was like, hold on, this is a broad crime that affects a lot of people.
He is absolutely the criminal. And that being said, when I say as a father, he's going to have to do time. If the problem is, as a father, you just had wished he had reached out when he needed more guidance, rather than digging himself a deeper hole.
I wonder where it went wrong though. Like it'll all eventually come out. No. What I mean is like, was FTX created because Alameda already had a hole, or was FTX created because Alameda was so successful, and then there were issues later on? And where did it go wrong? Where did he make that first bad decision that led to the next one, to the next one? Like, I can't figure it out.
We may not know for years.
But we all know that if you're in that situation, it's like you're making a decision where if you don't get away with this, you're facing years, if not decades, in jail.
I promise he didn't think that far down the path, and that's the danger of being young and unaware. You're just too young. You don't understand. Last night, and not to dox too much, we had a great dinner with Michael Saylor. Let me tell you, that man continues to amaze me with his brilliance. And it came up, like, where do his ethics as a publicly traded company originate? And he's very clear. And sorry, Michael, you can cut this out if you need to. But the truth is, he goes to the SEC. Look, people are scared of the SEC. Sam Bankman-Fried didn't have any reason to fear a regulatory body because they don't oversee his fund. Right. It's like having absolute control over your own empire, and there is no you don't have
There's no repercussions.
No repercussions. You don't have to answer to anybody. So you can mark your book however you want, as long as people don't realize that it's the fraud that it was.
Right.
Yeah, I mean, gosh, people won't like me hearing me say this, but sometimes I'm like, maybe we do need regulations, I mean, maybe we do.
Absolutely. Over to you, James, because we absolutely
like I'm not an anarchist.
I know you are,
but I do like the idea of a smaller state. I do like the idea. I don't like accreditor investor rules. There's a lot of things I don't like, but
they're outdated. They're not. I mean, they're not really. They cause more separation of wealth. Yeah.
But this wild west of anyone can do anything and get away with anything. I don't know. Certain things I think need regulation.
One of the most influential courses, and I said over to James, that
No,
I
I
took
think
at
it's good.
Cornell 1988. So 1987, how many years is that? Like close to, 40 years, right?
120.
But anyway, 35 years. A great class I took was called The Efficient Amount of Regulation. In any system, there is required amount of regulation. Okay, it's that simple. And within let's say crypto, and make sure we understand the difference between Bitcoin and crypto. If you truly want institutional adoption, which is the thing that will make number go up, you need a level of regulation that will allow those investors comfort that they are not entering into some sort of potential Ponzi that was mimicked by FTX.
Well, this was Tyler and Cameron Winklevoss's point. I mean, people didn't like the campaign. Crypto needs rules, and I would prefer it to be a bit more Bitcoin. But that's the exact point they're making. It's like no one's going to touch this if it's a Wild West. No one's going to touch this. I mean, how much capital has been eviscerated this last week? That is actual venture capital. How much of that has just been destroyed?
Right.
And like anyone looking in on this must be like, what the fuck is this all about?
Yeah.
Correct. And then don't forget the contagion that's involved. Over to you, James.
No, I think we were talking about this morning on our walk, and that's why you said over to me. And I just don't think that institutional money, like real institutional money, is going to come into this space until we have proper regulation. They're too scared of it. I mean, if you're a portfolio manager or a chief investment officer, what's the upside to getting into the space with so much risk, with so many of these schemes that have been unearthed in the last year? There's too much career risk in it. So they're not there's not enough upside to outmatch that.
Some Bitcoiners would say, yeah, good. Let's not have regulation. Let's leave it. Let's have a grassroots movement. Leave it for the little guy.
You can't suck and blow, okay? If they want the price to go to where they want it to go to, it will not happen without the big money.
Well, I think someone will say, well, let that come later. Mm-hmm. Let's build this a little
I
bit
would
slower.
agree. I would agree with that, but
I'm in the middle. Look, I'm in the middle. I just hate people getting fucking screwed.
Oh,
yeah, exactly.
There are people that will. I'm aware of people that lost their lives due to Luna. There will be people that lose their lives, take their own lives due to FTX and the losses that are absorbed there. In the grand scheme of things, in the global financial marketplace, the losses will be de minimis, okay? Within our ecosystem, there will be repercussions for a long time. Yeah. But from a global financial perspective, it's wipe it off the table.
Why? How could there have been so much systemic failure in the due diligence with this? Because I don't understand how a Sequoia can write a $200 million check without some kind of deep due diligence. I just don't understand it.
I mean, it's a good.
Or is this a fiat problem?
No,
but
sorry, it is a fiat problem. I know what I want to answer, but you go first.
Well, I mean, you're marking things to market, and FTT is marked where it is. Then you see how much it's trading, or what the number of holders are, and who holds it. Then you have a certain level of comfort, and it's just how much comfort does that one mark give you? That's like a starting point for some of these guys, Okay, let's start with what are the assets? But as far as all of the entities, I don't understand how they didn't pull this apart. I mean,
how about, okay, so I'll take it a step further. One of the tough games in private equity is, you want the next round always to be higher than the previous round, right?
No doubt.
And when you have a down round, which means a down pricing round where your Series B is lower than your Series A or whatever, that's not good for the valuation on your books. Right. Well, a lot of these guys will fund things at a higher valuation just because. It's good because they can take the stuff that they already have on their books and mark it to the new valuation, right? If they were in Series A and then the Series B round clears at a much higher enterprise value, that's good for the performance of the equity fund.
That's a little bit Ponzi itself, though.
There's no doubt that there are issues coming up about private equity marks on the private companies that they have funded.
So the way it works is in private equity. That's a great point. So the way it works in private equity, you come up with a valuation technique, and you try to keep should keep it consistent throughout the life of an investment. You know, whether you're doing discounted cash flows, or you're doing comparable valuations, whatever it is, comparable multiples, you know, to public companies. Those are pretty good metrics to use. You decide how to do it. You come up with your paperwork, your back work, your any information that could back it up in your models. Then you go to your auditor at the end of the year, and they look at how you valued them, and they decide whether or not to sign off on it and say, yeah, this is a believable valuation, right? So that's it. And unless you're audited, that's it. That's as far as it goes. So if somebody decides that they can, I mean, you know, it's not that the auditors are stupid. It's not that they're criminals or anything like that. It's just they're trusting their client. Now remember, the client pays the auditor to audit their books. So, you know, they're paying them to do this work. So it's a very close relationship. And so, not to be cynical there, but you know,
let's be cynical.
There are times where the auditors will just take your word for it and just go, you know, I've got a lot of work. It's the end of, and like when March 31st comes up, these guys are so busy. They're so busy that they're like, okay, you know, I'm going to have to take your word for it. And I'm
going to be cynical a bit.
Just a question on that very quickly.
You're cynical the whole show.
But
it's okay.
within Sequoia, whoever signed that off, will they face consequences, or would it be like they'll just write it off? Nah, this shit happens.
I believe it more closely to your second. You know, VCs make money. You know, there's 10 investments, 7 will go to 0, 2 will break even or slightly better, and the one that knocks it out of the park makes your return on the 10 investments that you've.
Yeah, it really depends on how big their investment is within the portfolio that the portfolio manager wasn't.
Let me pull a little bit more of the conspiracy theory. What if you do know that it is something that you have discovered there's fraud, but you want other people to come along and still mark it higher so that you're allowed to mark your prior investment up to the new funding round price. And you're like, damn, I hope they don't realize the things that I've realized up until this point, and I'll let them skate the project to the next level. Yeah. Okay.
Pass the hot potato.
Yeah. It's not passing it as much as just let's all hold our breath and pretend it actually isn't as bad as someone has discovered it to be.